Chapter 8 deals with capital budgeting. Capital budgeting just refers to the process of deciding which long-term investment projects the company wants to undertake. Now we have to be a little bit careful here because a lot of times when we introduce capital budgeting, students get confused because of terminology. And that's because we've been changing gears a little bit here. In chapters 4, 5, and 7, we've been talking about investments from an individual perspective. So in chapter 4, we introduced bonds and talked about bond valuation, things that made bond prices go up and down. Chapter 5, we talked about stocks and things that made stock prices go up and down. Talked about market efficiency and things like that. In chapter 7, we got into risk and return and diversification. But now when we talk about investments in chapter 8, when we're talking about capital budgeting, we're not talking from the individual's perspective. Instead, we're talking about the corporation's perspective. So here when we say investments, we're talking about things like investments into property, plant, and equipment. Maybe purchasing new delivery vans. It may be pursuing a new distribution center. It may be trying to develop new products. Things like that, not purchasing stocks and bonds, but instead investments in property, plant, and equipment within the corporation. I'm going to argue that capital budgeting is probably the most important decision a firm can make with respect to that primary goal of maximizing shareholder wealth. And the reason for that is that shareholder wealth, if you remember back from the idea of chapter 1, was based on the expected cash flow stream. It's essentially just the present value of all the expected cash flows that the company is going to make now and throughout the life of the firm. And really those cash flow streams are just the sum total of all the cash flows from each of the various capital budgeting projects. So companies that have good capital budgeting projects and have a track record that make investors think that they're going to continue to have good capital budgeting projects are more valuable. Companies that have a track record of bad capital budgeting projects are going to be less valuable because investors aren't going to expect as much cash flows. They're going to expect more risk as those capital budgeting projects fail. So good capital budgeting projects increase shareholder value. Poor capital budgeting projects can destroy shareholder value. And a few examples of that. One of the biggest is Apple with their history of capital budgeting projects. It started back with the iPod, several variations of the iPod, which led to the iPhone. And the iPhone had several variations, and then the iPad, which they're currently on their third variation of that. Those good capital budgeting projects have generated tremendous cash flows for Apple, but it's not just the cash flows they have generated. Instead, it's the track record that makes people expect Apple's future capital budgeting projects are also going to be very successful, partly because they have a built-in marketplace now. For example, a lot of people that have an iPhone 3 or an iPhone 4 or iPhone 4S probably are looking forward to the iPhone 5 coming out so they can upgrade to that. People that have an original iPad or an iPad 2 are more likely to upgrade to future iPads going forward. And people that have bought iPhones and iPads are probably going to be more interested in other future products that Apple comes out with. So their past track record makes investors think, hey, these guys are going to keep producing good products, and that makes them value Apple stock at a higher price. If we think of the Sony PlayStation, when Sony developed the PlayStation, it was a very successful gaming console. Followed that up with the PlayStation 2 and the PlayStation 3. Now, they wouldn't have been able to have the PlayStation 3 and have the success with that if they didn't have the PlayStation and the PlayStation 2. Now, investors are not only valuing Sony based on all their other projects as well, but also on their track record with the PlayStation. They know that people are still buying PlayStation 3s. They're buying games for PlayStation 3s, so Sony's going to keep making some money off of the game licensing. And a lot of people that previously purchased a PlayStation 2 or a PlayStation 3 are probably going to buy the next iteration. I don't know if it's going to be PlayStation 4 or some other name, but there's going to be a future iteration of that. And investors are valuing Sony not just based on the cash flows they brought in, but the cash flows they're expected to bring in. Lionsgate is a movie studio that stepped in and made an investment to purchase the rights to the Hunger Games books before the books even really took off. But once rumors started coming out about the Hunger Games movie coming out and how successful the books started becoming, Lionsgate's stock price went up. And Lionsgate's stock price not only reflects the success of the Hunger Games movie that was released this year, but also reflects the idea of Hunger Games 2 and Hunger Games 3 coming out in future years. Investors know that those movies are going to get made. They know based on the previous track record that people are going to go see those movies and they're going to generate cash flows for Lionsgate. So good capital budgeting projects can create tremendous value. However, we have flip side of that. There's bad capital budgeting projects. And we happen to be located where we can get a nice visual reminder of a bad capital budgeting project. When I came to Pittsburgh State in 1995, quite a few years ago, they were just opening up this brand new dog track up north of town. And if you drive by there today, you can still see the remnants of a parking lot and a grandstand and some kennels. The dog track was open for about a year. Turned out to be a very poor project. There wasn't enough interest in people going to bet on the dogs. The costs were higher than the revenues they were able to bring in. And so it closed down in about a year. A lot of money was spent. They weren't able to recover much of that money. So it ended up costing a lot of value. If you're familiar with Blu-ray DVD players, Blu-ray was not an automatic standard bearer for high definition video. Instead, there were two variations, HD DVD, which was backed by Toshiba, and Blu-ray, which was backed by Sony. Blu-ray won the standard wars. People don't want to have two different DVD players. So once one got critical mass, the other kind of died off. So HD DVD died out. While the iPhone has been a tremendous success for Apple, Microsoft has had much less luck trying to enter the mobile phone arena. One of their biggest flops is the Microsoft Kin. If you're not familiar with the Microsoft Kin, that was going to be their social media phone. And it was introduced to a lot of fanfare and was on the market for about 2 months before sales were so bad that they had to cancel it. So these capital budgeting projects that don't work out, instead of generating lots of future cash flows, end up spending lots of current cash flows and don't have a payoff down the road. So good capital budgeting projects can create tremendous value. Poor capital budgeting projects are essentially equivalent to burning money. We spend a lot of money, we get nothing back for it. Now here are extremes on the success and failure side. A lot of capital budgeting projects end up somewhere in the middle. Now when we start to evaluate capital budgeting projects, one of the things we need to do is separate the idea of independent versus mutually exclusive projects. Independent projects just means that we can choose project A, we can take project B, we can take both A and B, or we can turn around and reject both A and B. Taking project A has no influence on whether or not we want to take project B. They're independent of one another. So an example of this might be Microsoft, where project A is developing a new version of Microsoft Office, and project B is the next version of the Xbox. And so those two products are very different from one another. They're going to have different developers on there. They're going to have different target markets. If the next version of Microsoft Office looks good, Microsoft's going to pursue it. the next version of the Xbox looks good, Microsoft's going to pursue it. They don't have to say, well, if we take Microsoft Office, we can't do the Xbox, or if we take the Xbox, we can't do Microsoft Office. You can evaluate each one independently, and so they can take all the good projects and not worry about how they stack up to other alternatives. Mutually exclusive projects are a little bit different. Now taking one project prevents us from taking the other project. So an example of this might be a baseball team where Project A is the renovation of their existing ballpark. Project B is a completely new ballpark. They can evaluate both of these alternatives separately and decide which one is the best, but it doesn't make any sense to pursue both of them. They're not going to renovate the ballpark and then as soon as the renovation's done, tear it down and build a new ballpark. That doesn't make any sense. So they're going to evaluate those two projects and see which one is a better project, and that's the one that they want to pursue. So with mutually exclusive projects, it doesn't matter if the project is good by itself. It's not enough for it to be a good project. We have to identify which project is the best. So when we're evaluating mutually exclusive projects, our standard is a little tougher because now we don't have to just say, is the project worthwhile? We have to say, is this the best out of all the other mutually exclusive projects we're evaluating? Since we can only choose one, we have to make sure we get the best one. Now, when we evaluate capital budgeting projects, there are 4 basic criteria that we want to make sure we consider. Ideally, any decision rule that we develop or follow should meet all 4 of these capital budgeting criteria. Let's go through those. The first one is the decision rule should consider all relevant cash flows. By that, we mean it's got to consider the entire life of the project. For example, you could think of your college education as a capital budgeting project. You're spending money now, investing in your human capital. Hopefully, after you're done with your college education, you're going to be able to get a better paying job, higher cash flows later on in life. Now, if you look at your investment and you can only look at the first 5 years of cash flows, you're probably not going to evaluate your investment into your college education appropriately. Instead, you have to look at all the cash flows throughout your life in order to see if that was a worthwhile investment. Now, in practice, nobody knows how long your career is going to last. Nobody knows exactly how much more you're going to make with your college degree than you would have made without it. But that's part of the process, is trying to estimate those cash flows. And while we want to estimate those cash flows, we want to make sure we get all of them in there. For example, when Lionsgate was looking at the cash flows associated with the Hunger Games, it's important not just to think about box office revenues. They've got to think about DVD sales later on. They've got to think about any merchandising that might follow up as a result of that. They've got to think about not just the DVD that they release for the first movie, but once all 3 are done, the super supreme collector set that's going to come out and sell the DVDs all over again. All of those cash flows have to be factored in order to properly evaluate the project. The decision rule should recognize the riskiness of the relevant cash flows. Different projects have different levels of risk. So, for example, I mentioned earlier, Microsoft might try to look at a new version of Office and a new version of the Xbox. Which one of those is probably riskier? Probably the Xbox, because technology changes very rapidly. Consumers are looking for entertainment. They're the ones that are going to be buying the Xbox. A lot of businesses are going to automatically update Microsoft Office. People are going to buy new computers. They're going to get the new version of Microsoft Office attached with it. So Microsoft Office has a built-in kind of customer base for any new versions that come out. Now, not everybody's going to update right away, but most likely they're going to update over time so that you know within the next couple years a lot of customers are going to switch to the new current version. Whereas with the video game industry, you don't know. Maybe the new version of the PlayStation is much better than the new version of the Xbox. Or maybe the new version of the Xbox doesn't have enough bells and whistles to make people want to upgrade. Or maybe something else comes in that distracts people from video games and they don't want to play video games on a console anymore. Whatever it might be, the new Xbox is probably a little bit riskier. If it's riskier, then Microsoft needs a little bit higher rate of return. Going back to chapter 1, investors are risk averse, so if we want to take on higher risk projects, we need compensated for that. So our capital budgeting decision rule has to have some way to recognize how we adjust for that extra risk, how do we get extra compensation for that risk. Capital budgeting projects tend to be long-term in nature. We spend money today, we get cash flows over the next several years from those investments. Go back to the idea of your college education that I mentioned. You're spending money now, and if you spend, say, $20,000 total on your college education, and you get an extra $1,000 a year for the next 20 years, from a pure financial standpoint, you've lost money on that college education. Now, it may be worthwhile to you for other purposes, but from a pure finance decision, an extra $1,000 a year for 20 years is not equal to $20,000 in spending today. Instead, the longer you have to wait to receive those cash flows, the less they're worth. So we need to incorporate time value of money into our analysis. And lastly, we have to make sure that the decision rule we use ranks the projects so that those projects that increase the firm's value the most are ranked the highest. Now, this is a little bit long for our decision criteria, but I want to come back and talk about a couple things. A lot of times students will say the decision rule should rank the projects. Well, any decision rule is going to rank the projects. If my decision rule is to choose the one that comes first in the alphabet, I've ranked them by alphabetical order. Doesn't mean it's a good decision rule. If my decision rule is to choose the one that costs me the most, that's not necessarily a good decision rule, but it's still going to rank the projects. So I want to make sure I not only rank the projects, but I rank them in a manner that helps me maximize shareholder wealth. Remember, that's my primary goal. And the best way to maximize shareholder wealth is to take projects that increase the value of the firm. So those projects that do the best at increasing the value of the firm should be ranked the highest. Now, ideally, my decision rule is going to meet all 4 of these capital budgeting criteria. Some decision rules might, some decision rules might not. But when we try to identify our best decision rule, it's going to be the one that meets all 4 of these criteria. Now we're going to introduce 3 different decision rules in this class. There are several others out there, but the 3 are the big focus, and a lot of the other decision rules that are out there are variations on these 3. Payback period, internal rate of return, and net present value are our 3 different decision rules or decision techniques that we're going to use in this class. Like I said, there are some others. For example, there's a method called the accounting rate of return, which is similar to the internal rate of return. There's a method called the discounted payback period, which is similar to the payback period. So there are some other variations out there, but this is not an upper level finance class. It's an intro finance class. So we want to just introduce the basics of capital budgeting here, and we're going to start with these 3 methods. Now, why 3 methods? Why not just 1? Well, 3 different methods allows us to address capital budgeting from different perspectives. So each of our 3 decision techniques that we're going to introduce here is going to start with a different question. Payback period starts with the question, how long does it take us to pay back our initial investment? The quicker we can recover our initial investment, the better the investment is. And because it's asking how long, it's going to measure a time dimension. So when we calculate payback period, our answer is going to be in years. Now we have to make some assumptions about the cash flow streams in each of these calculations. And our assumption in payback period is we're going to assume that cash flows come in evenly throughout the year. So if our project makes $120,000 a year, we're going to assume that comes in about $10,000 a month. Not that it comes in $10,000 the first quarter, then $70,000 the second quarter, and then $30,000 the third quarter, and $10,000 the last quarter. Instead, we're just going to assume it all comes in evenly, that there's no seasonality involved. It just smoothly comes in throughout the year. That's going to be a little different when we get to our other two methods, the internal rate of return and net present value. Now, the decision rule associated with payback period is we're going to come up with this thing called a critical acceptance level. A critical acceptance level is just how long we're willing to wait to recover that initial investment. And that's going to be something that management determines. It's going to vary from firm to firm what they think a critical acceptance period should be. And it's probably even going to vary from project to project. For example, Walmart might be evaluating opening a new store. Well, that's probably going to have a little bit longer payback period, a little bit longer critical acceptance level, because Walmart anticipates that store is going to be in place for a relatively long time. On the other hand, if we look at a movie studio trying to evaluate the development of a new movie, that's obviously going to have a shorter payback period because that movie's got a shorter time horizon between when we start developing the movie and when the movie is released on DVD and those cash flows start to slow down. So we have to make sure our decision rule sets an appropriate critical acceptance period. And again, that's going to be subjectively set by management. And then any project where the payback period is less than that, it's a good project. So if we say we want our project paid back in under 3 years and we calculate our payback period and it's 2 years, that's a good project. If the payback period is 3.7 years, that's a bad project. If we have independent projects, just take all projects where the payback period is less than T, less than that critical acceptance period. If we have mutually exclusive projects, we want to accept projects with the lowest payback period, the quickest payback period that's also less than T. Now, at this point, what you may want to do is pause this PowerPoint slide and open up the online video for walking through the calculation of capital budgeting so you can see an example of calculating payback period, or go through the guided tutorial where it walks through the payback period, because that'll give you an idea of how to calculate it. This PowerPoint is more explaining it conceptually, but to actually walk through a calculation, that's how you're going to really get a feel for what the payback period is. So if you want to pause this, you can always come back, or you can finish the slide. It makes it real easy to pop back at the start of the next slide and restart the PowerPoint. Now remember, one of our capital budgeting criteria was we wanted to be able to adjust for risk. Payback period does allow us to do that. The riskier the project, the sooner we want to recover our initial investment. So all else equal, we're going to shorten that critical acceptance period for high-risk projects and lengthen it, extend it out a little bit for low-risk projects. That's going to allow us to adjust for risk up or down depending on the particular project. Our next method for evaluating capital budgeting projects is the internal rate of return. And again, remember I said the difference between these projects, the difference between these decision techniques is that they're trying to ask a different question. So payback period asked how long until we recover our initial investment. Internal rate of return says what rate of return are we earning on our initial investment. All else equal, the better the return, the better the project. So now we're looking at a return dimension. Your answer is going to be in a percent, 9.3%, 16.8%, something along those lines. It's no longer going to be in years. Now, because we're going to be doing calculations with internal rate of return on our financial calculator, we're going to assume cash flows come at the end of each year. Now, in practice, if you want to, you can be more precise. You could set this up as on a spreadsheet, and you could have cash flows come in every week or every month, or if you wanted to, you could even set them up every day and calculate an internal rate of return. In general, trying to be as precise as every day is pretty pointless because all your forecasts are going to introduce enough more error than you can possibly get by trying to be precise about the exact time they come in. There might be some argument for doing monthly or quarterly analysis at some point, but in practice, usually these are not precise numbers. We're making a lot of forecasts here. How much is the project going to cost? If you think of the example I've used of movie studios, oftentimes they go over budget. So that's going to affect the internal rate of return. But they don't know they're going to go over budget until after they've started. All these things are estimates. I use the example before of your college education. Well, what's going to happen to tuition over the time you're at school? What's going to happen to your pay raise 4 years from now? You don't know. So you're making forecasts. And those forecasts have errors. And those errors are probably going to be a little bit larger than the difference between trying to forecast quarterly versus annual cash flows. So here, our assumption is not realistic. Cash flows don't come in just once a year. You're looking at your paychecks over time, they're probably going to get paid every 2 weeks. But trying to model that and break it down every 2 weeks, you're creating false precision. So once a year, it's a shortcut. It's kind of a cheat. We're approximating, but the error it introduces is relatively minor given the overall error we get from assumptions. And it's going to make our calculations a lot easier, so that's why we want to do that. Now, our internal rate of return is going to kind of tie back to that expected return, required return issue from Chapter 7. The idea here is the internal rate of return is our expected rate of return, so we want to compare that to our required return, sometimes referred to as the hurdle rate when people are doing internal rate of return analysis, because that's the rate that the project has to clear a hurdle in order to be effective. Now, a little bit later on, when we get to our cost of capital chapter, in Chapter 10, we'll talk about where that initial or baseline hurdle rate comes from. But for this chapter, it'll start out as a given. So calculate your internal rate of return. Say that internal rate of return is 12% compared to your required return. If your required return says, I need a 9% rate of return to make this worthwhile, and you expect a 12% rate of return, you should take the project. On the other hand, if your internal rate of return is 5.2% and your required return is 9%, now it's not a good project. You should walk away. So if they're independent, any project where the internal rate of return is greater than the required return is good. If they're mutually exclusive, now we have to choose the best project. The best one is going to be defined as the one with the highest internal rate of return, as long as it's higher than that required return or hurdle rate. Just like payback period, ideally we'd like to be able to control for risk, and we can do that relatively easily with internal rate of return. We control for risk by increasing the discount rate or required return for high-risk projects, and we lower that required return for low-risk projects. It just goes back to Chapter 1. Investors are risk-averse, so they need a higher rate of return for higher-risk projects, can accept lower rates of return for lower-risk projects. So a very simple risk adjustment for internal rate of return. Again, this PowerPoint slide kind of discusses the concept of internal rate of return. Probably a good idea to pause right now, go through an example of calculating it. You can get that from the guided tutorial. I think there's an example in the online text. There's an example on the videos. And once you see a calculation, kind of review that calculation with the concept we're talking about here, and hopefully it'll all kind of line up for you. Our third and final decision technique that we're going to introduce in this class, again, changes up the question. Payback period was how long? internal rate of return that said what was our expected rate of return over the life of the project. Now, net present value, we're saying how much value are we adding to the firm? What is this project worth to us? And here when we're talking about what is it worth, we're talking about what is it worth net of the initial investment. So we have to take out how much it's costing us, add back in the present value of the cash flows, and if that's positive, that means we're adding value. If it's negative, it means it costs us more to take than we're recovering from the project. Because this is measuring value, it's a dollar dimension. So now our answer is going to be in dollar signs. Net present value of $10,500, net present value of $132 million. Whatever the base is, our net present value is always going to be in dollars. Just like internal rate of return, we're going to assume cash flows come in at the end of each year. Again, same reasoning. It's going to make our calculations a lot easier, make our life a lot simpler, and given the number of assumptions and estimates that go into net present value calculations, the amount of error that we introduce from this assumption is pretty small. When we use assumptions like this that are not necessarily realistic, our goal is to try to find assumptions that make life easier without having a big impact on the answer. And that's what this does. It makes the calculation a lot easier, doesn't distort the answer much. If you really want to gain that extra precision, I would argue usually it's false precision, but if it makes you feel better, then you could do these on a quarterly basis or a monthly basis or even a weekly basis and come up with much more precise timing. But again, the estimation error, I think, is going to make that a little bit of a worthless exercise. Now, because net present value is measuring the value added for taking the project, our decision rule is very simple. If we take this project, does it increase shareholder wealth? If yes, we should take it. So if the net present value is positive, it increases shareholder wealth. It's a worthwhile project. If the net present value is negative, then it destroys shareholder wealth and we should walk away. If we have mutually exclusive projects and we can only take one, we've got to identify the best project. The best project is the one that adds the most to shareholder wealth, so the one with the highest positive net present value. Again, risk adjustment is relatively simple. It's the same thing we do with the internal rate of return. We want to recognize risk aversion implies investors that take on higher levels of risk want to be compensated with higher return. So high risk projects, we're going to discount the cash flows at a little bit higher discount rate or required return. Low risk projects, we're going to discount the cash flows at a little bit lower discount rate or required return. We're not going to alter the cutoff point for net present value. We don't want to start saying, well, we only want to take the project if it adds 10 million to shareholder wealth or 100,000 to shareholder wealth. If it adds to shareholder wealth, it's a good project. We don't want to start lowering that cutoff for low risk projects and say, hey, well, this project doesn't have much risk, so as long as it doesn't cost or destroy more than $10,000, we should still take it. That doesn't make any sense. So instead of adjusting the cutoff point like we did for payback period and internal rate of return, here we're going to adjust how we do the calculation. We're going to change the discount rate when we calculate net present value, and that's going to be our risk adjustment. Again, I don't have an example in the PowerPoint slides, but there are examples in the online text, examples in the guided tutorial, examples in the video. So if you haven't walked through one of those examples yet, you might want to pause the PowerPoint here, go walk through some of those examples, get the calculation down, and that will help you understand the calculation conceptually, what's going on once you've walked through one. Now, one of the things we're going to find is not all of these decision techniques work equally well. For example, payback period is probably our most flawed model. If we think of payback period, it's got several problems. One, it may omit some of the relevant cash flows. Any cash flows that happen after the payback period are ignored. That's a problem. Also, it ignores time value of money. We're not using any discounting or anything like that. All we're doing is counting how long it takes us to recover that initial investment. Well, if we aren't receiving cash flows until 5 years from now, they're not worth as much to us as if we're receiving them today. However, in payback period, every cash flow that comes prior to that payback period point is treated exactly the same regardless of when it's received during the payback period. So ignoring time value of money is going to distort our decision process. It also doesn't rank projects by the value added. It doesn't give us a measure of shareholder wealth. If you remember, in our 4 capital budgeting criteria, we had 3 of them that are violated here. We wanted to make sure we considered all relevant cash flows. Payback period doesn't. We wanted to make sure we acknowledge time value of money. Payback period doesn't. We wanted to rank projects by value added. Payback period doesn't. The only one it does do is it allows us to control for riskiness. So it doesn't go 0 for 4, but it does have 3 major flaws out of the 4 criteria. Now, there's one other flaw on there that's not related to the 4 capital budgeting criteria, but what is an appropriate cutoff point for payback period? Should it be 2 years? Should it be 3 years? Should it be 3.478 years? There's no theoretical basis for what that cutoff point is. Now, we can kind of judge it based on how long the project is going to last, how risky the project is. We can come up with some things that might cause us to move that cutoff point up or down, but there's no basis for what our fundamental baseline cutoff point, our critical acceptance level, should be under the payback period. We haven't introduced it yet, but that required return from internal rate of return and net present value, that comes from a specific calculation called cost of capital. And net present value, the cutoff point is, does it add to shareholder wealth? That makes sense. So internal rate of return and net present value do have a theoretical foundation for the decision where that cutoff point is. Payback period doesn't. Payback period is a relatively flawed model, as we can see from this. Now, there are some instances where payback period might be useful. One of the biggest is for firms that are suffering through financial distress. If they're really suffering through financial distress, then it might be more important than normal to recover that initial investment quicker. Doesn't mean we would take a negative net present value project, but we might bypass a positive net present value project if the payback period is too long, and, this is critical, and that we're suffering from financial distress. Because if we go bankrupt from pursuing this capital budgeting project before we can collect the last couple years of cash flows, it's probably no longer going to be a positive net present value. So if our company is suffering from financial distress, doesn't mean we're going to ignore net present value. We still don't want to take a negative net present value project. Just means we might being the key word here, might bypass some positive net present value projects if the payback period is too long. Now, for the test, assume that we do not have financial distress unless it's clearly stated in the question. If I want you guys to consider that financial distress issue, I'll make sure I bring it up in the test question. So if it doesn't mention the company is suffering from financial distress, don't assume it is. Internal rate of return also has a couple of problems. The first problem, and let me quickly jump back here to payback period. In the guided tutorial, I walk through some examples of those problems with payback period and give some illustrations of where payback period might mislead us due to the specific problems. So one thing you might want to do is go review that guided tutorial, look through the problems with payback period, and make sure you understand how some of those errors can lead us to making poor decisions with payback period. Okay, now jump back to problems with internal rate of return. As I mentioned, internal rate of return does have some problems. It's a lot better than payback period. If you think of our 4 key capital budgeting criteria, internal rate of return considers all relevant cash flows, gets that check mark. Internal rate of return acknowledges time value of money. We use our financial calculator, so we're taking care of time value of money, gets that check mark. We can adjust for risk differences with internal rate of return just by adjusting that required return, gets that check mark. But what it does not do is rank by value added. Instead, it ranks by rate of return. Now that can be good in most situations. If we have independent projects, then that's going to be fine. If the project has a positive or has an internal rate of return greater than the required return, it's also going to have a positive net present value. So with independent projects, we don't have to worry too much about that last criteria. Internal rate of return, net present value, both going to do fine for independent projects as far as ranking. However, if we have mutually exclusive projects and we have to choose the best one, that's where the ranking issue becomes important. So ranking problems listed here, only important for mutually exclusive projects. The first one is a reinvestment rate problem. A reinvestment rate problem assumes that all intermediate cash flows are reinvested at the internal rate of return over the life of the project. In other words, if I receive $100,000 in year one and this is a 5-year project, we're not assuming I'm going to go spend that $100,000. Instead, we're assuming I'm going to reinvest it, and I'm going to be able to reinvest it at the internal rate of return. Let's pretend my internal rate of return is 30%. How realistic is it that I'm going to be able to reinvest that $100,000 at a 30% rate of return? Probably not very realistic. So in a situation like that, the internal rate of return is going to artificially bias that internal rate of return upwards. That's the reinvestment rate problem. Now that bias is going to be bigger for front-loaded projects that have high cash flows early on, and be much smaller for back-loaded projects, projects with cash flows that occur later on. So if we have timing differences, project A is front-loaded, project B is back-loaded, we're going to have problems with the reinvestment rate if, let me stress that, if we have mutually exclusive projects. Not a problem at all for independent projects, only important for mutually exclusive. Now, in the guided tutorial, I kind of spent some time talking about the ranking problem and an example of why that's important and explain it. So if you're struggling a little bit, this is not necessarily an easy one to keep track of. Make sure you look over that guided tutorial. And if it still doesn't make sense, ask some questions. Make a post in the discussion forum or send me an email, and I'll try to help you out with it. Now there are two ranking problems. The first is the reinvestment rate problem, which we've been talking about. The second is the size problem. This is a lot easier. Size problem just says, you know what? It's not important what our rate of return is, it's how much value we're adding. If you had two investments and you could only choose one of them, would you rather have a 100% return on a $1 investment or a 70% return on $1 million? Now remember, these are mutually exclusive. You can only do one. Assume that you can afford both of these projects, but you can only take one of those two projects. Well, if you take that $1 investment, you're going to earn $1 a year back. Well, as long as you have some change to pay for the taxes, you can go over to McDonald's and get yourself something off the dollar menu afterwards with your profits. On the other hand, with a $1 million investment, earning a 70% return is going to give you $700,000. You no longer have to eat at the McDonald's value menu. So obviously it's much better to get a slightly lower rate of return on a much larger investment. However, if they were mutually exclusive, again, independent, this doesn't matter, but if they're mutually exclusive, internal rate of return says that $1 investment is better than the $1 million investment. And really the opposite is true. The $1 million investment is a much better opportunity for us because we can make a lot more money for our shareholders. Now, size problem, very easy to identify when that might occur. If you have two initial investments that are approximately the same size, you're not going to run into a size problem. However, if you have two investments that are very different, like our example here, $1 million versus $1 million, and obviously that's extreme, but even if you think of a project that's $500,000 versus a project that's $800,000, there you're going to run into the size problem. So different initial investments are going to open up the opportunity for size problem. Ranking problems, both reinvestment and size problem, I've said this before, but let me just repeat it because it's important, don't matter for independent projects. They only matter for mutually exclusive, where it's not enough to decide if the project is good. We have to rank the project and choose the best project. Our last problem with internal rate of return is more of a mathematical issue. Essentially, the process for estimating the required return can generate multiple answers if we have cash flows change signs more than once. So if you have a project that starts out with a $1 million initial investment, earns back $500,000 each year in the first 4 years, and then costs you $600,000 to clean it up, you technically are going to get two different internal rates of return because your cash flows cross over twice. Once between year 0 and year 1, where you go from the $1 million initial investment, a cash outflow, to the first $500,000 that you receive at the end of year 1. So you've gone from negative to positive. That's your first crossover point. Stays positive in years 2, 3, 4, where you're earning your $500,000 at the end of each year. But then when you get to year 5 and you have that negative $600,000 cleanup cash flow, you've crossed over again. You've gone from positive back to negative. Multiple crossover points, multiple solutions. Now internal rate of return is unreliable. The crossover problem matters for both mutually exclusive and independent projects. Whenever you have a crossover problem, don't use internal rate of return, use net present value. It's going to give you a better answer. Just like I mentioned that there were examples of the problems associated with payback period, on the guided tutorial there's examples and discussion of the problems with internal rate of return. So go ahead and check those out as well, and hopefully between the PowerPoint slides and those examples, the discussion in the guided tutorial, you'll be comfortable with some of the flaws of rate of return. So payback period has flaws, internal rate of return has flaws. Net present value is the only criteria or only decision technique that meets all 4 criteria. Considers all relevant cash flows, acknowledges time value of money, allows us to control for risk, and it also ranks by value added. That's what net present value is measuring, is the value added. So ideally, we want to be making our decisions based on net present value. Now, interestingly enough, there was a survey done, and there's been a couple of these. I remember one done back when I was an undergraduate student quite a few years ago. And when they did that survey, internal rate of return was actually the most popular. So more people were using internal rate of return, even though it was a flawed method. And that's because at that time, finance was not quite as well established. A lot of people that were running upper level positions in large corporations probably didn't have that good of finance training. More of their finance training was general business or economics training. But as finance has done better at getting its message across, we've seen more companies move to net present value as their primary method. That's still not every company. And this survey itself here is 10 years old. This was done in 2002. So hopefully these numbers have moved a little more in favor of net present value. But as of the time of this survey, net present value is the most popular method out there. Internal rate of return is second, and payback period a distant third. Now, a couple things to note here. One, not all firms use net present value, but a majority, significant majority, do. A lot of firms still use payback period. Does that mean they think payback period is good? Not necessarily. Once you have the cash flows, though, it's pretty easy to do a payback period calculation. It's one more piece of information. Might not be the deciding piece, but note, these numbers add up to more than 100%. Many large firms use more than one method, and some of them are going to use methods beyond the net present value, internal rate of return, and payback period that we're talking about here. As I mentioned earlier in the PowerPoint, there are some alternative methods as well out there, including some more complex simulation and option-based analysis that might be used at some of the larger firms. But payback period is still used not necessarily as a primary tool, but just as another piece of information. And remember, as we talked about earlier, during some situations, companies facing significant financial distress, that extra piece of information from payback period might be more useful. So this gives you a little overview of how these methods are used in practice. Net present value is used the most, as expected. Internal rate of return, still used frequently. And the reason for that is usually it's a pretty good method. Remember, the only problems with internal rate of return occur when we have mutually exclusive projects and ranking is critical, or when we have a crossover problem. If we have no crossover problem and we've got independent projects, internal rate of return is going to be just as good as net present value. And a lot of people are pretty comfortable with hearing investments discussed as rates of return. And so internal rate of return is a nice intuitive way to discuss and explain the relative difference between the payoffs for the projects if we don't have mutually exclusive projects and if we don't have a crossover problem. This wraps up capital budgeting. Again, in addition to these PowerPoint slides, make sure that you go through the online text, go through the guided tutorial, and if you want to see some of these calculations visually, the videos walk you through and include a little bit of discussion as well. So hopefully that helps you with capital budgeting.